Good morning, everyone, and welcome to the webinar today. We have with us Mr. Shovik Gupta, founder of Infra.Market. Shovik is a CA with rich experience in P&L ownership and management. He's an alumni of IIM Bangalore and did his graduation from Sydenham College in Bombay. Welcome, Shovik. So as a background to this webinar, there's recently been a rating action by India Ratings, which has resulted in our rating getting downgraded by one notch. So in this context, Shobik, we wanted to hear your views and your future course of action on this.
Sure. So I'll take you through the rating points and I'll first answer those. Then I'll take any specific questions you have. But I'm hoping that majority of the points will anyway get covered when I sort of take you through the rating rationale and what are the points the rating agency has raised. So before I dive into the exact points raised by the rating agency, I first want to take you to some of the numbers that we're sort of achieving this year and what we're looking for next FY24. So as you know, FY23 we ended at around about 750 crore EBITDA with close to 12,000 crores revenues, and we had a debt to EBITDA about 2.4, which was a substantial improvement from 22 of around 3.7, and the rating agency had and a net debt to TNW of 0.71. So this was the sort of numbers that we have. FY24, our net debt to EBITDA will still be sort of 2.7, 2.78, which is within what the rating agency has mandated for us. But obviously, our overall metrics in terms of EBITDA percentages and everything has improved. Our EBITDA percentage has increased from 6.5 to almost 7%. But they have taken a decision to downgrade. So we would like to take out the key justifications and what we feel about the rating action that has happened. One of the first points they have raised is the lack of equity fundraise in financial year 24. So what we want to clarify here is that we did raise close to 150 crore equity in FY24 through a stake sale in RDC of 10%. We are currently going through a pre-IPO round in RDC. We're selling another 10%, of which 5% we've already signed up agreements and the money is hitting the bank. Already some of it has hit the bank. We are raising this at around about a 2,200 crore equity valuation. And that is a substantial uptick from last round. So around about 2,500 crore enterprise value we are raising in RDC. This money will hit the bank. Part of it will hit the bank before March, 100 crores before March, another 100 crores in April. So around about 10% further stake sale as we take RDC to go public. So that is currently in process. So that equity will come in. Apart from that, there is a equity round term sheet that we've received from an investor in Infra.Market. That is also a premium to last round valuations. And we are expecting that to close ideally by June. We are mentioning September, but I think ideally we've already received the term sheet. The diligence is already in process. So we think hopefully by June, July, we should have the money in the bank. Apart from this, on RDC Concrete IPO, we've already appointed bankers. And we expect us to be able to raise another 500 to 600 crores through RDC IPO, which we are planning in FY25. So DRHP is going to be filed in June for the RDC IPO. And we've already appointed bankers and all the process already started. So we are essentially targeting more than 1,000 crores of equity over the next 6 months, primarily through RDC stake sale and HELA primary raise. And out of that, 200 will come in the next 45 days itself. So March and mid-April. And the balance is staggered till September. So over the next 6 months, we expect almost 1,000 crores of equity infusion into the company as primary. And as the 200 crore comes in, we will definitely go back to the rating agency and ask them to reconsider, and we'll ask them, at least inform them of the positive development and see what their reaction to this is. So in terms of the lack of equity infusion, I think majority of it will be solved, partially at least in April itself and balance by September. As you all know, we had acquired RDC for around 600 crores. So there is a substantial uptick in RDC valuations also, which is actually coming from the increased performance of RDC in the overall and the overall performance of the group itself. So I think it also shows the overall how the operating metrics of the company is improving. One more concern that the rating agency had raised was is basically the increase in capex. So we had given a rating agency a guidance on around about 100 crore capex that we'll do in FY24. And the actual capex that we are ending up for the year is around about 510 crores for the year. We will end up at. Now, the rating agency has taken a negative view on this, saying that the capex has increased. One of the things that we would like to submit, which we have mentioned here, if you just read this particular para, is that we typically used to work with contract manufacturers who are manufacturing for us in many categories. As we are aware, we don't own all the manufacturing. We outsource some of the manufacturing. Now, in that sort of scenario, we were paying them a rent or a job work charge. Right? Now, instead, what we have done is we've done some capex and we are paying EMI. I understand that the capex has increased and the debt has increased due to that. But essentially, there is no extra cash outflow to the company due to this decision. Today, I was taking a plant on rent and paying them lease. Tomorrow, I'm shifting that to a situation where I am going out there and acquiring the plant and paying EMI. This has resulted in an EBITDA improvement. It results in a PBT improvement. But it does not result in any additional cash flow outflow for the company because I was anyway still paying my contract manufacturers that amount. The entire the 510 crore breakup is as follows. 125 crore has been RDC. Around about 82 crores for concrete in Hela, and around 300 crores for walling solution, that is AAC block plants in Hela. Now, the RDC was already part of the budget, and they have done it through internal accruals, and they have a HDFC has sort of a primary lender there who sanctioned that. In Hela, what we've done is we've raised 150 crores of equity last year through RDC stake sale. That combined with the bank loan by Union Bank, who's primarily funded the AAC block plants, is how we funded the AAC block capex. However, what guidance we've given to the rating agency is that any future capex that we do, we will align it with the equity raises. So, as for example, in March and April, when we raise close to 200 crores equity, then we will sort of align the capex so that there is no further debt raise for these matters, right? For capex. Although we continue to believe that our capex is necessary, we are one of the largest manufacturers now in concrete in India. If we don't do any capex, we are putting ourselves at risk by depending only on contract manufacturers. So some capex will be necessary, but we will time it with equity fundraisers so that there is no further debt pile up due to capex. Most of the capex debt is also low cost debt. However, we will still rationalize our capex and ensure that there is no further capex till we get those equity infusion in place. There's one more point that was raised is if there is a 3.25, if the debt EBITDA increases above 3.25, right? And they wanted us to maintain below 3.25. So what we are trying to mention here, in December, it is close to 3.15. One of the reasons it is high in December is that our industry typically does not work equally across the years. There is a sort of a depression in July, August, September, October. This is primarily July, August, September, primarily due to monsoons, and October, November, early November due to primarily the festival season. There is a shortage of labor availability, and there is a dip. So overall industry goes through a slump. Now, in this sort of a situation, when you analyze the December EBITDA and take it for the year, the EBITDA numbers are obviously lower than expected, and that has resulted in a net debt to EBITDA appearing high. We are very confident that when we come to March 24, our net debt to EBITDA will be around 2.7, which is the guidance we've given to the rating agency. So we will obviously, once March happens, I think they'll get more clarity on it. Our EBITDA numbers of December and Jan are much better. Sorry, Jan and Feb are much better than up till December. And I think that will also come through when the rating agency will ask the rating agency to reconsider our downgrade. So one point that they had raised was a low DSCR. They have mentioned that we have repayment obligations of 17 billion, that is around about 1,700 crores over 24-25 2 years, and which primarily pertains to acquisition debt. So out of this 1,700 crores, 700 crores is already repaid. Okay? Only 1,000 crores remains in the next 15 months, of which we are raising close to 800 crores from RDC stake sale alone. Also, we are already sitting on more than 400 crores of free cash. today on the balance sheet. We are also sitting on more than 150 crores of unutilized CC lines. So if you look at our overall repayment obligations in the next 15 months is 1,000 crores, of which 400 crores is in the bank as cash already. 200 crores, close to 200 crores is unutilized CC lines, so around 600 crores of cash plus unutilized lines. And we have 200 crore equity coming in March, April, and we have another equity round happening in September. So even if you combine, even if you just consider 200, we are more than enough capitalized for repayment obligations. And our DSCR will improve substantially post the equity infusion. So once if you consider the equity raise in place, our DSCR will move way more than one. It will not, there'll be no repayment issues will not come into place till FY25 ending. There mean even all the 1,000 crores is well capital. We are well capitalized for 1,000 crore repayment over the next 15 months. And any equity raise above this will further make it easier for us to manage the repayment obligations. One of the concerns was the increase in stake in Shalimar Paints. So what we would like to say here is that, look, we were at 26% in Shalimar, and it did not make much sense for us to continue at 26%. And we were going to we are trying to increase to a majority. We've achieved majority there almost. And the amount that we've infused in Shalimar Paints is around 250 to 260 crores in part of the open offer. And majority of it has been raised through a convertible facility with Kotak Private Credit Fund. It's not Kotak Wealth, it's Kotak Private Credit, sorry. So it's Kotak Private Credit Fund. And this is primarily a 4 to 5 year structure, where some of it is payable after 3 years, some of it after 4 years. And there is no monthly or quarterly repayment. It's a bullet structure. And we believe we'll be able to turn around Shalimar similarly as we have demonstrated with RDC Concrete. And once that turnaround effectively happens, we will be able to actually ensure that the amount that we've invested in Shalimar is more than justified, and the repayment of the Kotak Private Credit Fund transaction will happen via stake sale in Shalimar in the future. Because and we have enough time, we have more than 3 years from now for repayment. So at that moment, we will definitely deleverage through Shalimar stake sale and ensure the repayment is taken care of. The last point raised was regarding income tax. Now, on income tax, we'd like to clarify that I think we've already provided all the data to even the Yubi team before. You can look at our financials. It also mentions that all demands till date have been provided for, including interest penalty and every other obligation that may come up on the demand. There is no further action by the income tax department. We have gone to appeal against the demand. The appeals have not yet started. There is no further action. All the action that is going to happen now is on the appeal by the appellate bodies, where they will hear where the maximum demand has already been raised. Now they will hear our justifications, and we will hope that there is a turnaround on the appeal part, and the demand is reduced or removed from us. So there is no further action by the departments. There is nothing pending from the department side, and we have already filed all the appeal documents. We are waiting for a hearing date for the appeals. So I will be happy to take any questions. This is mainly on the rating. What I'll also do is I'll now share where we are currently on the monthly performances, and I'll also share. So if you look at our monthly, we are currently Jan end, we are close to 700 crores of EBITDA. And we think we will end up around 950 to 1,000 crore EBITDA for the year. And we are currently at a PBT of 370 crores, which we think will end up around 500 crores, 500 crore PBT and 400 crore PAT for the year in FY24, which is the number that we are guiding towards at the beginning of the year. We are also have a couple of questions. One was share point A again. I'm not sure which point A, if it is someone has asked a question. So someone wanted to understand the CAPEX capital raise points. So on the capital raise, yeah. So on capital raise, what we are mentioning is we are expecting a fund inflow of 200 crores in March and April from RDC stake sale. Of the 100 crores already been signed. and the money will come in by March, another 100 in April. And we are appointed bankers for the RDC IPO, which we are expecting sometime in September. And we have currently a term sheet under discussion with the PE investors for infusion in Hela. So all three put together will raise around about 1,000 crores in FY25 in the first half of FY25. We won't go into the second half, the first half of FY25. I'm just answering one of the questions asked here. So
Again, would request the participants to ask any queries that they would have in the chat box.
yeah, so I was going through. So I was going through the MIS. Like I mentioned, we'll close to around 1,000 crore EBITDA this year, with around about a 400 crore PAT is what we are targeting, and we are on track for those numbers this financial year. I'll also take you through the model where we are guiding for next year for better. Yeah, so like I said, this year we'll end up at around 1,000 crore EBITDA, close to 400-450 crore PAT. And next year we are guiding for a 1,450 crore EBITDA number. And this year's numbers are almost, we are already in Jan. So this is a fairly fairly sure on these numbers. And once we hit these numbers, I think our debt to EBITDA numbers, like I mentioned, will be close to 2.5 to 2.6, max 2.7 on the debt EBITDA, not more than that. So one of the question was on, so I've got one more question here on debt obligation for the next 15 months and how we plan to repay it. So the debt obligation for the next 15 months is 1,000 crores, of which we have today cash availability on the books of 600 crores already, which includes 400 crores free cash and 200 crores unutilized CC lines. 600 crores already there. And we're raising 200 crores in March and April. Plus, we have cash flow from operations. We are currently generating 100 crores of EBITDA, almost 50 crores, 60 crores EBITDA cash flow from operations every month. And we have a 500 crore equity raise coming up by September. So even if we leave out the equity raise, we are well capitalized for repayment. Post April, we will have 800 crores of free cash on books, and even if we don't raise equity, we are well capitalized. The assumptions, there's one more question on assumptions behind margin improvement year on year. So margin improvement, we have only assumed a contribution margin improvement. If you look at my entire model, we have not assumed any benefit of economies of scale. So if you look at it, we're going from a 12.4% CM to 7.1% EBITDA, which is a 5.3% corporate and expenses and employee cost, which is actually, this is 5.4%, and this continues to remain around about that number, 13.7 to 8. So mainly the margin improvement that we're talking of is actually between, if you look at between FY24-25, at the contribution margin level. This is primarily due to better density, better scale, logistic cost reducing, our profile between private labels and other brands improving. And so if you look at what we are mentioning is that as we get denser in each city, so our obviously logistic cost will reduce. We have a fixed logistic cost. We rent in vehicles and use them. So as they do more trips during the day, they will eventually have lesser, more utilization and lower logistic cost, leading to a contribution margin increase. So one question was, rating agency had mentioned that a debt EBITDA of 3 point. Yeah. So we will go to the rating agency. I think we will go to the rating agency post March, because what will happen is that our 200 crore of equity will come in, 100 crore in March and 100 crore maybe first 10 days of April. So post that, we will go to the rating agency with the March numbers, and we will see what their stand is on that. We believe our net debt to EBITDA will be below 2.7, and we will have 200 crores of equity coming. Post that, we will go to the rating agency. That's my reply on that. So I'll just wait for the equity come. So can you please elaborate on one more question that has any lender recall? No, there are no. In fact, most of the banks, I think category A, they are more comfortable to continue lending lines, and there are no covenants where there's a lender recall due to rating downgrade. One more question. So one person had asked whether there are any lender recalls owing to rating downgrade. So there have been none, and we don't expect any. And none of our covenants have any one notch downgrade as any lender recall obligations. So one point is, could you please elaborate on the turnaround plans for Shalimar? So on Shalimar, we are under a sort of a quiet period due to the open offer undergoing till 12th March. And we can't give any forward-looking statements right now on Shalimar. So I'll have to take that, maybe we can take that offline and take it post 12th of March. We can give you more detailed projections on Shalimar Paints right now. But the basic idea with us is, look, we are already present in B2B, B2C and retail, and we will basically take up these, we will take Shalimar as a brand and try and induct it in all our retail stores, all our retail distributors, B2B distributors. But I can't give you exact numbers that we plan to hit for FY25 right now, considering it's a listed company. So one question is case of equity fundraise gets delayed, what is planning? So we have not considered equity fundraise in our overall plan for repayment. So what I've again mentioned is that we plan to raise 1,000 crores of equity, of which 200 that is already signed and coming in March, April. That's the only one we've considered in the plan. So when I say my debt EBITDA is 2.7 or my DSCR is going to be more than 1, I'm not considering the liquidity events, any equity event. Even without the equity events, we are well capitalized to meet our debt obligations. The equity events will be additional cash inflow to the business. And what we are hence mentioning is that if and when the equity comes in, we will primarily use it for capex, and we will not do capex before that. Hence, we are delaying the capex and linking it to the equity events. But we are not contingent on equity events to meet any day-to-day operational requirements. But like I said, the 200 crore that we are planning right now in equity raise is already signed up and coming, and part of it has already been received. So that will close before 10th of April. And the balance, it's contingent on certain events closing, but we expect it to happen by September. And if that doesn't happen, then the capex plans of the company will get delayed. Or if there's a delay, there will be capex plans delays. How much is the impact of debt obligations as a result of downgrade? There will be no impact on debt. There could be some coupon resetting, but I don't think any repayment. There is no repayment obligation change due to downgrade, single notch downgrade. One more question is, have we received any further sanctions post downgrade? Downgrade has happened only 7 days back. We are expecting a couple of sanctions next week, but uh, we've only had like 7-8 days post downgrade, so we've not received any new sanctions yet. What you assumed is that, so what was one saying is the rating agency raised a flag on current leverage. Based on current state of affairs, how will the leverage be managed? So I've already mentioned that the rating agency has taken EBITDA till December and annualized it for the year. We don't have a great Q2, and typically 4 months of July, August, September, October are not great months. Hence, the leverage appears higher. We will go back to them in April with the new leverage, new debt EBITDA, and the equity raise that is happening in April, and ask them to reconsider. And the amount that they were anyway considering is, um, they have mentioned 3.25 in the, if you look at the rating rationale, well anyway today also below 3.25. It is, and I think even when March will be much below it. So one point is the finance cost has increased from 1.7 to 2.9. Yeah, the finance cost overall has increased from 1.7 to 2.9 due to, if you look at 1.7% in FY21 to 2.9 due to two acquisitions that were happening. And we've raised 600 crores and we bought RDC. And now we are selling RDC, part of RDC, and actually we've increased the value of RDC from 600 to 3,000 crores. So uh, so even if you take into that consideration, even if you take that into consideration, there will be a reduction in the debt because the reduction in the acquisition debt anyway. So there will be overall reduction in finance cost debt in because of the stake sale in RDC. So this increase in finance cost as a percentage of revenue is primarily due to acquisition debt, which is getting repaid from stake sale. So I think one question that Gaurav is asking is an increase in 0.5% of the coupon This will result in a yearly increase of around about 5 crores, I think, on a yearly basis. It will not have any substantial impact uh, because I don't know. I don't think if I don't have the exact number, but I think the NCDs which have this clause is around about 500 crores of NCDs, and that will result in if this rating downgrade continues for the entire year, then there'll be a 1% of that is around what 5 crores. 0.5 will be 2.5 crores. So that was the question was what is the total impact on finance cost or repayment obligation as a result of 0.5% increase in coupon. So that will result in a 2.5 crores on an annual basis.
Shavik, there's one question on the new segments that we are looking to enter and how the margins will shape up over the next 12 months. So if you could kind of touch on that.
So I don't think we are launching any new segments right now. We are primarily across all segments. We are trying to go deeper into certain segments. We are now tiles is something that we are very aggressively looking at. We also have a very large plans in MDF and plywood. I think what we are now doing is that various categories we are going from distribution to pure play private label. That will increase margins substantially for us. And that has already been covered in the model. If you look at the model, we are sort of going from 12.4 to 13.5. That has primarily been factored in for next year. Any plans to further reduce cost of debt? And we already got a sanction from Union for 300 crores in Jan, not Jan and mid Feb. So well, maybe Jan or end of Jan, early Feb. That is close to 9% cost of debt. We are also expecting a sanction from a couple of more PSU banks. So that will reduce the cost of debt substantially. Some of our NCDs that we have raised have been used for acquisitions, but some NCDs have also been used for financing working capital gaps. As we raise more PSU or sort of low cost debt, we'll replace those working capital gaps. So we already, like I mentioned, got a large sanction from a PSU bank in like a month back, and we're expecting one more sanction in March. That will sort of reduce our cost of debt substantially.
Thanks. Then, Shavik, there are some questions around the strata acquisition and the Vardy debt that was
So
being.
I think that they're expecting at Strata is sort of not working for us. So we are at the moment at least not looking at reinitiating. I mean, we see it's not a question of reinitiating. There is a lack of meeting on minds on valuation expectations. So at the moment, it's off for the time being. We are not reinitiating that. At least for now, I don't see currently any situation where I'll be reinitiating that. Yeah.
You also you mentioned about the Union Bank. I think there's some question around that. If you could also give color on some of the other bank sanctions that we are working on and which are expected to come in shortly.
Yeah, so we already have a expectation. We already are working with 2, 3 PSU banks, and I don't want to discuss particular name, but I think we are expecting around 300 crore to 400 crore of CC line sanctions in March, which should come in, and that is what I was mentioning even in the earlier question. Any new sanction post the rating downgrade. So we've not had any right now, but I think by 15th of March we'll be able to give you good color on this.
Sure.
Union Bank sanction is a 300 crore sanction. Cost will be around 9% to 9.25%. Tenor is it's a CC. It's a large part of it is CC. So CC is usually renewable every year. And then there is some term loan. I think it's a 80 or 10-year for the term loan. Sir, maybe on the Union Bank sanction, if some of you require, Sumit can share the exact sanction. Your team has it. Chandra and all already have it.
Yeah,
But we can
one
share.
will
Yeah.
finish. Yeah.
Yeah. I don't know exact this. Are the Union Bank lines drawn? No, right now it's first week of Feb only it got sanctioned. So even in the rating rationale or whatever we have shared, we have not considered the Union Bank lines as drawn because we just got it sanctioned and disbursement just happened last week final because it took us like 10-15 days for documentation there. The sanction happened, final sanction came in end of Jan, disbursement in Feb. And that's what I was mentioning. We have more than 200 crore undrawn lines today.
So on that point, Shavik, again, if you could highlight the current cash position and also the undrawn sanctions that are there, I think that would give a
Yeah,
lot of.
so like I said, we have close to 600 crores of current cash on bank, of which more than 400 crores is free cash. I'm not considering the lean cash. 400 crores is free cash. Apart from that, we have more than 200 crores of undrawn lines. So around about 600 crores of cash to undrawn lines. We are currently raising 200 crores, of which 100 crores has come in. And so we'll come in, and so that will further make it around 800 crores. Now, considering no further equity raise, and we still are well positioned to meet next 15 months repayment obligations. Next 15-month repayment obligation is 1,000 crores, of which we are sitting on 600 crores of cash plus undrawn lines and 200 crores being raised in March, April. And we're not considering any cash flow from operations. We're not considering any EBITDA, any cash coming in from business in all this. So we are more than well capitalized to meet repayment obligations. And the equity raise of 200 crores that we're discussing will happen anyway in the first week of April itself. I mean, in March and April. It won't go into, at least 100 crores will come in March.
Sure. So I think most of the questions that way have been addressed. Participants, if there are any further questions, you can anyway share it with the UB team and we'll kind of get a response from Shavik and get back to you. So thanks, Shavik. Thanks for your time and thanks everyone for joining in for this webinar. We'll continue to keep engaging with the team and happy to address all the questions or queries that you would have. Sorry, I think there's one question that has just come in.
There's one question that just came up. This one question was, why is the rating agency not? So rating agency is not that they are not. They have downgraded as one rate, and we were supposed to raise equity last year. I think once we raise the equity, they'll reconsider. Is what the feedback I got. But we will go back to them. At the end of the day, to be very honest, an A minus is not a bad rating for a company of our scale, size, high growth. Growth is something that high growth companies, the kind of growth and sort of acquisitive companies, and the current environment around startups is not great. And I think the macro environment sort of doesn't work in our favor. We are one of the few startups who have acquired companies and actually increased their valuations, turned them around. I mean, if you look at other startups who have acquired companies, that hasn't got very well in the industry. We are being looked at as a slightly highly acquisitive company, although we've only done 2 acquisitions. I think all those did not play in our favor. I think the RDC equity sale and the IPO will go a long way in proving our credentials in turning around an acquired company. I think that will be very critical in this. So they have kept the outlook negative. So they have just downgraded one. No, so I think one of the questions is, why is the outlook negative? So the outlook was negative before also. It was A with outlook negative. They've downgraded exactly one notch and made it A minus with outlook negative. It's a one notch downgrade. So both the outlook and everything remains the same. It's one notch downgrade. RDC on negative. So RDC on negative watch was also not on watch. They're not put it on watch. Again, outlook negative. It was also on outlook. RDC rating has remained the same. So if you look at RDC, it was A minus. It is currently A minus. RDC, they have not changed the rating at all. On RDC, they have not taken any call. They've almost made the rating around the same. We will on RDC, we feel that they have been too conservative. The company has improved a lot. And I think the overall metrics at that company, from going from 50 crore EBITDA to 200 crore EBITDA, and the overall debt to EBITDA reducing actually in the RDC. Debt to EBITDA is below 2 for RDC, has not been considered by the rating agencies for RDC. I think they have linked it to here, the parent. They have said if the parent is A minus, we'll keep it at the same rating. And that is the only reason they've kept it at the same rating. And RDC was always A minus and they've kept it at A minus.
Thanks, Shavik. That kind of addresses all the queries that we have on chat.
Yeah.
And like I said, any further queries, we can anyways get in touch with the
Sure.
We'll kind of get it.
And the UB team, I already shared the Union. Chandra has the Union Bank sanction. If they need any further details, happy to share. Yeah.
Thanks once again for everyone for joining in. Thank you. Thank you so much.